The stock market has come a long way from its humble beginnings in the 17th century. What began as a tool for pooling capital for high-risk ventures has evolved into a global financial system that drives economies, builds empires, and occasionally crashes hard. From the Dutch East India Company's first IPO to today's complex, high-speed trading platforms, let's embark on a fascinating journey through time. The first stock issuance. Dutch East India Company, 1602. The Dutch East India Company, often referred to by its Dutch acronym Verenigde Oost-Indische Compagnie, was established in 1602 and is widely considered the first company to issue shares of stock to the public. This innovative move allowed everyday citizens to invest in the company, which held a monopoly on the lucrative spice trade with Asia. The Verenigde Oost-Indische Compagnie wasn't just a company. It was more like a government, with the power to wage war, negotiate treaties, and establish colonies. Its initial public offering in Amsterdam set the stage for modern stock markets, creating a way for individuals to profit from global ventures. At its peak, the company was worth around $7.9 trillion in today's dollars, making it arguably the most valuable company in history. In addition to spices, the Verenigde Oost-Indische Compagnie traded goods like silks, porcelain, and precious metals, and was a symbol of Dutch imperial might. This model was revolutionary for the time because it allowed investors to share in both the profits and risks of global trade. The first stock exchange, Amsterdam. To facilitate the trading of Verenigde Oost-Indische Compagnie shares, the Amsterdam Stock Exchange was established. Widely regarded as the world's first stock exchange, it became a marketplace where shares in the company could be bought and sold. This exchange introduced concepts like liquidity and price discovery, which remain fundamental to stock markets today. The exchange itself was a bustling scene where traders, merchants, and investors negotiated prices, made deals, and occasionally sparked speculative bubbles like the tulip mania in 1637. The tulip mania is often cited as the first recorded speculative bubble, where the price of tulip bulbs soared to astonishing levels before crashing back down. Amsterdam's stock exchange paved the way for financial markets across Europe and eventually the world. Its success showed that public markets could provide essential capital to companies while offering ordinary people the chance to invest in business ventures. The ideas developed in this period, such as stockholder rights and market regulation, are still relevant in today's markets. The emergence of other exchanges. Following Amsterdam's success, other cities soon established their own stock exchanges. London was next, with its stock exchange formally established in 1698. Paris followed in 1724, as European economies grew and industrialization began to take root. These exchanges were simpler than today's markets, but they played an essential role in funding everything from railroad expansions to mining operations. By the mid-18th century, London's exchange had become a major hub for global finance, benefiting from the city's strategic position within the British Empire. Each stock exchange developed its own rules and practices, some of which became standardized over time. For example, London's exchange introduced the practice of listing prices for different stocks daily, a concept that evolved into modern stock market indices. As these markets grew, so did the number of companies issuing stock, including large industrial corporations that would shape the future of the global economy. Speculative bubbles, the South Sea and Mississippi companies. The 18th century was also the era of speculative bubbles, with two of the most infamous being the South Sea bubble in Britain and the Mississippi bubble in France. Both were driven by overenthusiastic speculation on future profits that never materialized. The South Sea Company, established in 1711, promised massive returns from trade in the Americas, leading to skyrocketing share prices. However, when profits failed to materialize, the bubble burst in 1720, ruining thousands of investors. In France, the Mississippi Company bubble, created by Scottish financier John Law, followed a similar trajectory. Investors believed they would get rich from the company's control of trade in the French colonies, including Louisiana. However, when it became clear that the company couldn't deliver on its promises, share prices plummeted, leading to a financial crisis that almost bankrupted France. These events taught the world some hard lessons about speculation, financial bubbles, and market regulation that are still relevant today. The Industrial Revolution and expansion of markets. The Industrial Revolution in the 19th century brought about an enormous expansion in the stock market. As factories, railroads, and steamships transformed economies, companies needed vast amounts of capital to fund their operations. Stock markets became the go-to method for raising this capital, and exchanges flourished. This period saw the rise of the London and New York stock exchanges as dominant financial centers. During this time, the number of publicly traded companies increased dramatically, with industries like steel, oil, and railroads leading the way. Investors flocked to these new markets, eager to profit from the explosive growth of these companies. However, this era was not without its problems. Unregulated markets led to financial panics, with the Panic of 1873 and the Panic of 1893 highlighting the need for better oversight and regulation. Wall Street and the rise of America. While European markets dominated in the 19th century, by the 20th century, Wall Street had risen to prominence. The New York Stock Exchange, founded in 1792, became the leading exchange in the world, especially as the U.S. economy boomed after World War I. By the 1920s, Wall Street was synonymous with wealth, speculation, and the American dream. However, this era of unchecked optimism came crashing down in 1929 when the stock market collapsed, triggering the Great Depression. The crash wiped out millions of investors and led to widespread financial hardship. It also prompted major reforms, such as the establishment of the Securities and Exchange Commission in 1934 to regulate markets and protect investors. These reforms helped restore confidence in the stock market and laid the groundwork for the sustained growth of the mid-20th century. The Roaring Twenties and the Great Depression. The 1920s, often called the Roaring Twenties, were a time of rapid economic growth, technological innovation, and stock market speculation in the United States. Many Americans believed the stock market was a guaranteed path to wealth, leading to widespread investing by people who knew little about finance. However, this speculative boom came to a crashing halt on October 29, 1929, Black Tuesday, when the stock market collapsed. The crash wiped out billions of dollars in wealth and triggered a global economic depression. Governments around the world responded with a range of economic reforms, including Roosevelt's New Deal in the United States, which aimed to stabilize the economy and prevent future financial crises. The lessons of the Great Depression profoundly shaped modern economic policy, including the importance of market regulation and government intervention during economic downturns. Post-war boom and globalization. After World War II, the stock market experienced unprecedented growth. The U.S. economy was booming, and the stock market became a central component of American life. In the 1950s and 1960s, many Americans invested in the stock market for the first time, encouraged by rising wages and a growing middle class. This era also saw the rise of institutional investors, such as pension funds and mutual funds, which began to dominate stock trading. Meanwhile, stock exchanges around the world were modernizing and growing as globalization took hold. In Europe, the Tokyo Stock Exchange became a major player, while emerging markets in Asia and Latin America began attracting foreign investment. The world's financial markets were becoming increasingly interconnected, setting the stage for the modern global economy, the digital age, and high-frequency trading. The 1990s ushered in the digital age, transforming the stock market forever. The rise of the internet made it easier for individuals to trade stocks from anywhere in the world. Online brokerages like E-Trade allowed retail investors to access the stock market without needing a traditional stockbroker. This democratization of trading led to a surge in individual investors entering the market during the dot-com boom of the late 1990s. At the same time, advances in technology gave rise to high-frequency trading, where firms use algorithms to execute trades in fractions of a second. High-frequency trading now accounts for a significant portion of trading volume in U.S. markets. While high-frequency trading has increased market liquidity, it has also been criticized for contributing to market volatility and creating an uneven playing field for smaller investors. Today's stock market, a global powerhouse. the stock market is more influential than ever. Companies like Apple, Amazon, and Tesla dominate, with trillion-dollar valuations driving both investor optimism and fear of overvaluation. Additionally, the rise of environmental, social, and governance investing is reshaping how companies are valued as investors increasingly seek ethical and sustainable investment options. The market remains a vital engine for economic growth, but as history has shown, it is not immune to cycles of boom and bust. And that's a wrap on the fascinating history of the stock market, from the Dutch East India Company to the modern-day powerhouse it is today. If you found this video informative and entertaining, don't forget to smash that like button and subscribe for more awesome content. Got questions or thoughts on the stock market? Drop them in the comments below. Let's keep the conversation going. Thanks for watching, and see you next time.